First of all, I would like to thank Mr. Dispenza and Mr. Demory for inviting me to this General Assembly. It's a great honor and a pleasure to be here with you today. As Mr. Dispenza anticipated, I would like him to do a little bit of, to offer a little bit of a perspective on our view on the role of natural gas and LNG in particular in the context of the energy transition. Most of the analysis that we will see during the presentation have been part of our constant research on the global energy perspective and on the global gas outlook, which our Energy Insight team constantly perform for the firm. In particular, I would like him to spend some time to reflect on the evolution of the global energy demand and the discontinuities which are in front of us with the energy transition. To move then into the, the role of natural gas, and in particular for LNG as the fuel for the transition, and then close the reflection with some of the challenges that we see in front of us for this industry to really make the LNG the fuel of the transition. I would start with something that we all know about the energy demand. The energy demand, as you know very well, is fundamentally driven by three factors. The first one being the population dynamic, the second one, the economic growth of the planet, and the third one is the energy intensity of our societies combined with the energy efficiency level. If we take a look to the overall situation and the forward-looking perspective of energy demand, what we observe is the energy demand coming from the planet is decreasing, is decelerating. It's fundamentally expected to continue to grow at 1.2% till the end of the decade, but then with a lower growth estimated in the range of 0.8% for the subsequent decades. The deceleration seems to be structural. It's fundamentally driven by three factors. The first one being the aging population, which is de facto decelerating the GDP growth of the world. In particular, as you can observe from the chart, we have been used to grow the planet at the GDP level of 3.6% over the past 50 years. You know, studies and research expect the GDP growth to be substantially lower for the next 50 years, in the range of 2%. At the same time, the world is becoming incredibly more efficient in terms of the energy consumption. We reported, the impact on the liters per kilometers of our vehicles, a significant improvement in the energy efficiency of the transportation fleet. Last but not least, all the major economies on the planet are structurally shifting from industrial sector to service sectors. You see there the report of the impact for China, for India, and for the US. This seems to be a structural shift to service economies, which by definition are less energy intensive compared to the industrial one. If we move to the regional dynamic, what we observe is that all the energy demand growth for the next 15 years come from the non-OECD countries. And this is exactly the same for the subsequent 20 years to come. In particular, in the first part of the time period, China will fundamentally leading the chart with accounting for more than 44% of the energy addition. The situation will shift in the subsequent period of time with China fundamentally flattening and most of the growth coming from India. This means a substantial and structural change of the energy demand and the geographical dispersion and contribution to the energy demand growth. If we then move to the industrial sectors, what we observe is a particular dynamic. Most of the growth of the primary energy demand is generated by the power sector and by the industrial sectors. They respectively account for 36% and 37% of the energy addition. The power generation demand increase is clearly determined by the acceleration of the electrification of the fast-growing market and the big, emerging markets coming up in the next foreseeable future. At the same time, the power generation observed a radical change in the mix of fuels which will be utilized for the future. In particular, you see the massive increase of non-fossil fuel components, which is fundamentally driven by the increase of the wind and solar power combined with the stability of the nuclear power. And at the same time, the power generation will continue to increase the consumption of gas to fuel the energy mix. In the industrial sector, chemicals is the subsector which is leading the charge, is fundamentally growing incredibly fast across the globe and outstripping the growth coming from the heavy industries like iron and steel, which are de facto flattening, particularly in China, in the long term. Even for the industrial sector, there is an energy mix reconfiguration with gas and non-fossil fuel representing a substantial increase for the future. Building continue to remain important for the energy demand, accounting for 14% of the total growth. And transportation accounts for 13%. In both those two sectors, we observe the general trend of a remix of the energy component. If we take a look to the fuel mix, natural gas is becoming an essential fuel in the sustainable energy transition, and LNG in particular. On the left-hand side of the page, you see the dynamic of the different fuels. Fossil fuels will remain more than 75% of the fuels consumed on the planet by 2030. But when you go into the detail, you observe that gas is fundamentally growing at 1.6% over the next 15 years, while coal is fundamentally flattening by 2020, and oil is flattening too. The dynamic remains true even for the subsequent 30 years. If we dig deep into the dynamic with the gas fuel, what we observe is the LNG, as already mentioned, continues to remain the fuel with the fastest growth on the planet. LNG is expected to grow at 4.6% over the course of the next 20 years, significantly higher compared to the remaining source of gas. Well, it's a good news for the industry. It's a good news for the sector. As mentioned before, the market is evolving. And when you look at where the growth is coming in terms of consumption of gas, and in particular of LNG, what you discover is that the largest portion of the LNG consumptions in terms of additions are coming from two new buckets of market that here we call the recent market entrants. More than 15 new markets have and are entering the space of LNG with new additional demand, and more than 10 are markets that we consider likely to emerge in the future. Of course, all those markets, stack on top of the more traditional market that we have been used to serve over the course of the last 2 decades. This generates a more fragmented buyer's market, which, if it combines with the more fragmented supply side, generates additional competition and pressure in the market, which is clearly becoming a global trade market. In such a context, as the market evolves, LNG buyers are becoming more sophisticated, and their wants, what we call wants, their requirements, are fundamentally evolving, driven by three major concerns. The first concerns that we observed is the ability to forecast the volumes which are needed in the specific markets where the buyers operate. It's a world of uncertainty. It's a world with policy energies not stable, with economic growth incredibly volatile. The buyers are facing the challenge to be able to properly focus the volumes for the future, and hence are challenged to commit to high volume risks. At the same time, as we have seen, the LNG is a substantial source of the energy mix in some of the economies, and the absolute need to achieving sustainability of LNG price, which means an efficient LNG price, is crucial for the buyers. It's a contribution to the competitiveness of the country where they operate. The third concern is the ability to assure the security of supply in a world where the supply side is becoming more fragmented, with new supply chains coming on stream. With regards to those three concerns, buyers are becoming more sophisticated and are putting them in pressure on the supply side to get the best offer for their respective needs and for their respective markets, which includes competitive price, which includes, a wider set of indexations combined with the more traditional ones that we have observed over the course of the last 10 years. They are incredibly interested in the reliability of the supply chain. The past was used to be focused on the reliability of the plant to be able to produce the volume and to get the volume delivered. Today, buyers are more concerned on the reliability of these suppliers, which is not only technical, it's commercial, it's financial, as the ability of these suppliers to back up contracts with portfolio schemes. And at the same time, they are diversifying the supply side by fundamentally having more sellers for the same buyer. The contracts, you know the story better than I do. Contracts have been changing and evolving over time. There is clearly the need for a shorter duration, but at the same time, more flexibility in terms of volume. And what we observe is portfolio of buyers have been evolving, having a constant component of short-term buys and more flexibility in terms of destination. It's a market which has become more sophisticated, and the sophistication of the market is a clear concern for the supply side. When we move to the supply side, and again, you know the market better than I do, what we observe is fundamentally an LNG market which is, as we speak, so to speak, balanced. The expectations with the additional capacity coming on stream, which is the light blue area in the middle of the chart, the expectation is that in the next 5 to 6 years, the market will fundamentally have an excess of capacity vis-a-vis the demand line, which is the red line on the chart, with possible uncontracted volumes estimated in the range of 50 million tons per annum by 2021, and a constant price pressure for the industry. But when we move forward to the next decade, what we observe is that the demand continues, to fast growing at 4.6%, as we said at the beginning, and, the industry requires a substantial addition of capacity to meet the demand that today is estimated in 180 million tons per annum post-2023 in order to meet the demand by 2030. it's a significant addition. The industry is clearly not short of planned projects, but the challenge will be delivering. If we reflect on the current market scenario, and if we share, some of the points that we discussed so far, we tend to believe that the industry has three fundamental challenges to be able to fulfill the potential for LNG to be the fuel of the transition energy. I would summarize, those challenges in 3 points. The first one is the timing of the new F IDs. As we saw a few minutes ago, there is a potential big gap between demand and supply post-2022, 2023 by 2030. The question is, will the new liquefaction projects take FID on time to be online by the time that they are needed? The second is the timing and the pace of cost deflation across the LNG value chain to allow the industry to be efficient and competitive in terms of final price to the customers for the LNG to capture the demand which is theoretically available in the market of destination. And the third one is the contractual behavior. As we observe, the market has evolved in terms of developing short-term contracts, and the question is, the short-term contracts and the preference for the short-term market will evolve and will be able to sustain the ability of the industry to take final investment decision going forward. And as was initially anticipated, would the market require a different operating model to be able, to deal with the uncertainty and with the allocation of risk which is needed for the industry to continue to flourish. Let me go one by one with few facts. The first challenge, the timing of new FIDs. Our perspective is that if too limited new FIDs are made in the coming 3 years, this could result in a significant market tightness by 2030 and in a possible disruption of the potential demand for the LNG in order to the market and the industry to be balanced. You see two complicated graphs over here. The first one on the left is fundamentally the capacity with the stack up of the planned project for the future, assuming the red part of the graph, assuming FIDs are taken as planned or with a limited delay. If that happens, provided those projects are competitive, there will be potentially enough capacity to meet the market demand, and the market could balance out. But the challenge is in the delay. As you can see on the right hand of the chart, if the delays happen, which seems to be the case, even remembering the notes from Mr. Dispenza, very few new projects have been sanctioned in the recent past. If the delays happen, there will be no time enough to stack up capacity to meet the demand, which could possibly result in a demand disruption on top of a market, of a price spike. The second challenge, the timing and the pace of the cost deflation. Again, another complicated chart. What is reported here is what we call the cost curve of the industry. This is the full cash cost, CapEx and OpEx, for the planned and post-FID projects as we know them at the moment. On the horizontal axis, you see the capacity. On the vertical axis, you see the cost expressed in dollars per million BTU. The blue vertical line in the middle of the chart represent the capacity which is needed to meet the famous 470 million tons of demand by 2030. The challenge is that if we do believe in a low for longer in terms of oil price, and we assume a $60 per barrel forward, the LNG industry needs an LNG potential price in the range of $7.5 to $8.5 per million of BTU to be able, to make some of the potential additional capacity available and viable to the market. Which means a challenge for the buyers in terms of competitiveness of the fuel that they may want to buy, and the challenge from the supply side because it requires a significant compression of the cost to develop our projects. The experience tells us that there are levers for the supply side to become more efficient. I just mentioned a few of them, even because I think you're very familiar with that. Well, the first one, phased and modular developments of the new resources to try to optimize the cost equation and the cash flow equation to finance the development. Modularization, designed to value a lean engineering to rethink the liquefaction facilities so that they could be, more efficient in terms of cost of developing. Lean drilling to minimize, the cost of the gas at the wellhead of the plant. Construction productivity. We have observed massive overrun over the course of the history in stick-built plants. It remains a challenge, but what we observe is there is the way to potentially drive productivity up and reduce the cost of delivering those resources. Last but not least, the new technical solutions. Floating LNG, small-scale LNG, FSRU for the destination terminal, they are all potentially available and in progress in terms of cost competitiveness to serve the industry to find a more efficient development scheme. It remains, in anyhow, a challenge, particularly in a volatile environment the way we observe it today. The third challenge, the contractual behavior. This is something I mentioned before. The spot market grew substantially over the course of the last 5 years. It accounts for more than 25% of the volume traded on a global basis. And this is something which happens, which is, according to our understanding and perception, which is there to stay. At the same time, when you talk to the buyers, what you discover is that there is still a substantial preference for long-term contracts. 61% of the buyers that we interviewed told us that they like long-term contracts. But we tend to believe that there is a new definition of what long-term contracts are. Because when you analyze this preference by duration, you discover that there is a significant part of the buyers that are willing to commit for shorter-term contracts, still long-term, compared to the ones we have observed in the past. 52% told us that they would prefer contracts between 5 and 9 years with the possibility of roll them over. Then there is the remaining 48% have expressed different preferences depending on the specific markets where they are and the specific situation that they need the LNG for. The message is, in a more competitive market, in a more fragmented market in terms of supply chain and buyers market, we tend to believe that a viable balance between short-term and long-term is required for the industry to be able to unlock the potential and to be the winner in terms of the fuel for the transition. We don't have the recipe since it's very complicated, but what we tend to believe is that can be achieved through revisiting the way risks and investments are distributed along the value chain and reallocated to the different players, and through different operating models, which are, by the way, already coming to the market. It's an opportunity and a challenge at the same time. Before opening up to questions, I would like to just summarize the key points that I wanted to highlight. If you take a look to the global energy demand evolution, natural gas has the opportunity, and in particular LNG has the opportunity to become the fuel for the transition energy. The market is radically changing with a significant demand increase in the next 20 years coming from what we call new emerging markets, which make the market more fragmented and more competitive. The market is balanced, has the possibility to go long in the next 5 to 6 years, but the big challenge, according to our view, is for the back end of the new decade, where the industry will require significant addition of capacity in order to fulfill the demand and to fulfill the possibility to be the fuel of the transition. As we said, 3 challenges. Delays of new F IDs can create unbalance and demand disruption, putting at risk the possibility for the LNG to be the transition fuel. Cost deflation is a must in order to be able for LNG to be a competitive fuel in the different markets, and to the suppliers, to bring those resources on stream. Buyers will probably need to take on more risk and to have a more balanced view on the way they want to contract resources going forward to support the industry in unlocking the potential which is there. I would like to conclude saying it's an uncertain world with a lot of challenges, but we tend to believe that the proper and the new collaboration between buyers and suppliers could help the industry to figure out the new operating model for the future to navigate through the uncertainty, still to capture the potential which the demand growth for energy makes available for our industry.